Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on that internet thing, YouTube, youtube.com, search Bloomberg Podcast, and that's where you'll find the broadcast here. Boy, what a movement in these markets over the past 48 hours. Big sell-off yesterday. Even a little bit of a panic in the morning, it felt like. But then turning it around here on Tuesday. Peter Tchir, head of macro strategy at Academy Securities. He joins us live here in our Bloomberg Interactive Broker Studio. Peter, you've got some experience. You've been around the block once or twice. What do you make of kind of the last several days of trading?
You know, I think we're starting to see a little bit of an unwind. We saw a little bit of fear. I think whether it's the carry trade or not, it kind of pushed us in. There's a lot of leverage in the system. A lot of people have been selling volatility. A lot of people bought, full in on the AI story. I think those are fading a little bit. And yeah, we're getting a little bounce today. I think we're going to see more selling, though.
Exactly. That was what I was worried about. Like
dead cat bounce, which I was shocked we had to explain that to somebody. But anyway.
Whatever. Why do you think it's going to be more selling? Because I was looking at the systemic funds and worried there, the gamma hedging, the carry trade not being done. What do you see that tells you more selling?
Yeah, I think a lot of those, and even on a simple level, you just look at QQQ. It took in inflows. SPY took in inflows. And even more esoteric, TQQQ, which is a levered, took in inflows yesterday. And
that's a levered S&P 500?
Leveraged NASDAQ 100.
NASDAQ, okay, thank you.
And then my favorite one, I think, is NVDL, which is a leveraged NVIDIA ETF. And that had inflows yesterday. So I would like to see outflows there to really believe we've had some capitulation.
So what does that tell you, though? It just tells you that it's still a buy-the-dip mentality in some way?
I think it's still a buy-the-dip mentality, okay. But I think, yesterday everyone was so calm. Hey, don't worry about this. It's all fine. People reacted. I think there's more going on. The economy's slowing. We have stretched valuations. The Fed is not going to be super supportive of markets. They've got their own agenda, which is to kind of make sure we don't get inflation again. So I think we're very ripe for selling on any sort of earnings weakness or economic data weakness.
What have you thought about the earnings? Let's go back to something that presumably still matters in the markets. What are you making of earnings?
That we finally have a higher standard for what's going on with AI. 6 months ago, certainly if you just raised your hand and said, we have an AI strategy, you were rewarded. The chip companies were all rewarded almost no matter what. And it feels like people are putting a little bit of scrutiny on this, saying where valuations are. And unfortunately, I think so many of these stocks got heavily piled into that they're a little bit overbought. And the other part that we've been talking a lot more about is the concept of passive, right? Passive, so whether you put your money into the S&P 500 or NASDAQ 100, about 50 cents on the dollar are going to just a handful of stocks. So that fed the momentum on the way up, and I think it's going to fuel the momentum, unfortunately, on the way down.
Right, so it can go up in a straight line, and then it can also go down in a straight line. It doesn't have to go down differently. Do you think the Fed should cut 50 basis points in September?
I don't think so yet. I think, I think they should have actually cut in July, and I would have done 50 in July just to get this out of the way.
You would have done 50 in July. Why 50 in July?
You've seen a nice slowdown in everything on the inflation front. The only thing that's holding up CPI is the owner's equivalent rent, and gosh only knows why we still use something like that. Anything that's, a contemporaneous measure of inflation, rent, whether it's Zillow, is showing rents of decline. The other thing that's kept CPI up was auto insurance. We're not seeing that come through. So I think they could have reacted to that. I think the job number have been overstated. I don't like what's going on in the private. The JOLTS even had a big reduction in private jobs available. Get ahead of this. Plus, I really am scared. A 50 bips cut in September, right in the heat of the election, I think it's just going to become a political nightmare, and people are going to be screaming at the Fed. It's going to detract from the Fed's mission, I think, which I think they are very good at. I would have cut now, see where it goes, and let it play out.
Once the Fed does begin cutting, it's been such a long time, at least in my mind, how do they do it? Do they kind of go 25 basis points every meeting? Do they skip meetings? How do they do it?
That's kind of my view. I would have liked to see a 50 on the first one and then wait 2 or 3 months. I think in September, unless the data comes in so weak, they do 25 and then push the next one off till after the election. I think a 50 in September, if it really sparks a big equity rally or something, will be troublesome. They want to not reignite inflation. So to me, we get 25 and then they wait a month or two. And it really is going to be dependent on the data. I think the data is going to turn out weak and justify more cuts, but it might not.
What do you think of the corporate credit market? I was looking at high yield spreads yesterday, and I know that they rose, and I get that. But compared to other events, it's still so calm.
Yeah, I think, credit really isn't the valuation story, particularly investment grade credit, right? The companies are great. Across the board, there's still cash flow. The economy is still growing to some degree. So it makes sense to me that spreads widened a little bit in sympathy. I am starting to watch, though, if the Russell 2000 rolls over, because that to me is a good proxy for what's going on in high yield. What really did encourage me yesterday, we had some selling pressure on high yield, but the ETFs behaved very well. What I don't like is when you see the ETFs start trading at a big discount to NAV. That to me tells me there's an overwhelming amount of selling pressure. We didn't see that yesterday. Clearly not seeing it today as the market does well. That's my one trigger to watch, is how the ETFs behave relative to NAV. And if they do well, that's healthy. And we will get a small correction in credit spreads. You have to with equities down here. But there is no credit problem this time around.
What are you seeing in ETF flows? What gets your attention these days?
Again, just this continued buying into the kind of riskier end of equities. No one's giving up on the tech trade. No one's really giving up on the AI trade. And so every time I look and we see these sell-offs, I'm thinking, okay, maybe we got de-risking. And what I think we've been doing is getting de-grossing, which to me is people taking off longs and shorts. So that sometimes shows up as rotation. And I think people are taking off some of these more levered trades, the selling of options, et cetera. But we really haven't seen anyone say, I want out of this market. There's this real belief I've got to hang in. Yeah. And that's what I'm waiting for, is something that changes there. The only thing that I thought was neat, I'm starting to watch the Chinese stock market again. I actually kind of like FXI for the first time in a while on the ETF front.
Well, what's your level of confidence that we get that kind of event? That capitulation, event?
I think it's reasonably high. It's,
okay.
And part of it, like last Wednesday, right? We were up 500 on the NASDAQ last Wednesday as the Fed was speaking. I didn't see what justified that. So there was very little liquidity. That sucked people in. I think it helped set up for the Thursday, Friday, Monday trade. And here again, we're kind of rallying. Everyone seems too excited. There's no real fear. And the odds are, again, I think people are much more cautious on the earnings front, right? And people aren't getting the free pass, that something comes on that. And I really am very nervous that we've been overstating the economic growth, and we're going to see some weak data. So that's, I guess, my bet is we get a data or an earnings print that triggers another round of selling pressure, and people are too long once again.
You said you're looking at China. How about the Nikkei index? Our friends in Japan, crazy couple of days.
Oh my God, yeah.
Man.
Yeah, and I do think that's been one problem we've been talking about for ages, is this faux liquidity, I've been trying to term it. And that these markets seem liquid because the screens are all priced, but it's all very algo driven. There's no real support at any given time, and you can have these big moves. It's, now that it's summer, if you go snorkeling or something, you see a school of fish and you put your hand near the fish, they disappear. They immediately recongregate. And this reminds me of the sort of pattern that we saw in around the financial crisis, these air pockets where something's trading normally, moves 5%, then starts trading normally again. They're like, whoa, what happened to move 5%? And that to me shapes us up more for a downside than an upside.
So for the carry trade, so speaking of, is that how that winds up playing out? Like eventually there's even more upside pressure on the yen and then it just blows out other positions?
Yeah, so, the carry trade...
So define the carry trade.
So in theory, I think people say you borrow in yen, you keep it in yen, and you buy U.S. assets.
Gotcha.
I think, to me, it's just more there was leverage in the system, right? The carry trade, more traditionally, you would buy, fund yourself in yen and buy U.S. treasuries. Treasuries rallied yesterday. I think there's a little bit of a boogeyman sort of thing going on where the carry trade is just a small part of this. I think what it really is people got over-levered. They went to full positions. They went aggressive end of stocks. They bought leveraged ETFs. They did all these vol selling strategies. So I think it's leverage in the system, not a specific yen carry trade.
So it's not like I just borrowed in yen to buy NVIDIA.
No, and there's the thing, the 6 degrees of Kevin Bacon, you can picture him. So I don't know about you.
So
I
yes,
know
maybe,
all,
but
I know all sorts of people in this market. I can't find anyone who admits to having the carry trade on before this all started. So I think some of that's overstated. I think this is really just good old-fashioned leverage and people borrowing and putting too much risk into the market.
All right, Peter, great stuff. Really appreciate you coming in. Peter Tchir, head of macro strategy at Academy Securities, joining us live here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We had some political news today. Vice President Harris taps Minnesota Governor Mr. Walz to be her vice presidential candidate on that ticket. Laura Davison joins us, Bloomberg Politics Editor. So, Laura, what's the feeling within D.C. about the selection by VP Harris?
This is a little bit of a surprise pick. We've heard Walz's name come up, as these discussions had gone on over the past couple weeks. But Walz is someone who was relatively unknown just prior to really Harris emerging as the Democratic standard bearer following Biden's departure from the race. So, he's a very popular governor, in Minnesota, but not someone who's been on the national stage as much. But he really emerged because he was sort of able to capture on the zeitgeist of the moment. He, kind of coined the phrase "weird" now that sort of as an insult to Republicans and their policies that Harris and others have started using. And so he was sort of able to be seen as someone who could go on the attack, but also, sort of be relatable and likable to blue collar workers.
What does that mean then about how Kamala Harris feels about Pennsylvania?
So it's clear from this decision, sort of the main other person she was looking at was Pennsylvania Governor Josh Shapiro. He's also very popular in his state and would have been sort of the best choice if she wants to make sure she wins Pennsylvania. So either, the kind of a couple takeaways here, she feels confident about her chances outside of Pennsylvania, that there's, multiple ways to win the race. But also Shapiro had some negatives. He was very staunchly pro-Israel, something that, is a divisive issue among Democrats. And one of the things that sort of her allies pointed out, after this decision was made, that it was Walz she had more of a personal rapport with. So that was something that she was looking at very closely. Plus, he also had a record in Minnesota that had more middle class wins. So things like free lunches for school children, expanding paid leave. Shapiro has less experience as a governor. He's only been in office for 2 years, has a little bit more of a mixed record, for Democrats. For Walz here kind of helps her shore up the progressive base.
Does this pick say anything about how Kamala Harris wants to run this campaign in terms of being more of a centrist versus appealing maybe more to the liberal part of the Democratic Party? What do we think?
Yeah, so Walz is someone who does appeal on a policy level to progressives. He has, someone who comes from rural Minnesota. The district that he represented when he was in the House is now represented by a Republican. But his values and sort of the issues that he champions are much more the progressive wing. Things like paid family leave and expanding, student loans and student loan forgiveness, rather. Shapiro is much more moderate, much more business friendly. So this is sort of, an interesting, mix here. But because he does have those Midwestern roots, he is from a rural area. He is someone who, has been a gun owner, though has become much more vocal about, gun control in recent years. He has this sort of mix that he's able to, not alienate either the moderate side or the progressive side of the party.
Terry Haynes of Pangea said this was Harris's first negative. He didn't like it. He was basically saying this was a safe pick. It showed that she's really worried about the campaign. Is anyone in the zeitgeist that you're talking to sort of saying that?
Yes, I mean there is sort of a different schools of thought here, but that that Walz was someone that wasn't going to offend anybody, and so therefore he's safe. But he may also not have the same upside potential that someone like Shapiro had. Shapiro on the ticket, the chances of winning Pennsylvania and therefore potentially the whole race went up. But he also has more negatives here. So she was sort of taking the path of least resistance on this pick versus someone like Shapiro or even Mark Kelly, who had some clashes with labor unions in the past. So that it was sort of another issue that why his name didn't rise to the fore.
All right. Well, thank you so much. We appreciate it. It's definitely a crazy time. And also, you have such a short amount of time with that. Laura Davison, Bloomberg Politics Editor, joining us. But, it's so truncated.
Yep. And now they hit the road immediately. I mean, I think 7 swing states in 5 days or something along those lines. So they're going to be hitting the road. And obviously former President Trump and J.D. Vance are out there as well. So it's be a relatively short period of time till we get to Election Day.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us on YouTube. Don't miss us there. So to get a big perspective on the market, if you're a long-term investor, what do you do over the last, 48 hours in the markets? This is when I get like my financial guy sending me the email of like, just so you know, this is what happened. This is what we can expect. So how do you do that? Well, Margie Patel is Senior Portfolio Manager at Allspring Global Investments, and she joins us now on Zoom from Boston, Massachusetts. Margie, what do you make of the last 24 hours? Or 48? Is this a regime shift, a real paradigm shift, or is it still stay on message, stay on trend?
I think it's still the same things. Large cap stocks are still going to be the place to be for the rest of the year. I think what happened is after a few quarters where the Mag 7 or the dozen largest stocks reported better than expected earnings, that gave the market a real boost in confidence. And this time we had really sort of mixed results where some of the companies reported results that were frankly disappointing. And that took away market confidence at a time when you had stock prices at their peak. You have concern about what the Fed is going to do. Data that says the economy is slowing down. So I think that's what we had is just a real short-term step down, S&P down 9%-ish, NASDAQ down 12, 13-ish, and really just a short-term correction that's almost played out. We probably have a little bit more, and I think we'll go up for the rest of the year.
So, Margie, to the extent that we do go up for the rest of the year, is tech going to continue to lead this market, or have we seen some kind of rotation that is of note?
I don't think we'll see much of a rotation because when you look at the economic growth level, what you think the economy will grow at for the next few quarters, I think it'll be rather low, 1%, 1.5%, something like that. So that says you still have to stick with those sectors that have above average growth, which again would be tech in particular, some other sectors, but primarily tech, especially when a lot of these stocks have had such a big correction. They're really priced more or less in the middle of their value range. So if the earnings go up, we think that these stocks can go up too.
So I guess this is a buy the dip kind of setup for you, Margie?
Yeah, sort of, especially some of those names have had big corrections. But it's interesting although people talk about the correction, when you look at the indexes, Standard & Poor's, NASDAQ, Dow Jones, those indexes are all still up very attractively year to date, mid to high single digit for a little over halfway through the year. So that says that's really on track to be an above average long-term rate of return for stocks, certainly not a disaster. And even if you look at something like NVIDIA, which I think is down 40% from its peak, it's still up 100% year to date. So it isn't as if we're having a real unwinding, 2000 type internet bubble meltdown, a permanent impairment. I think this is just a short-term correction, typical in summer, and then we'll see the market move ahead in the rest of the year.
Hey, Margie, how about the fixed income market? I'm looking here at my INGO function, the Bloomberg Index browser. It says across fixed income, I'm seeing 3-4% type total returns. That's about as good as I've seen in a long time. What do you think about opportunities in the fixed income space?
Yes, it is, because actually many sectors of the fixed income market have been negative as rates have gone up. Prices are sensitive to that and they've gone down. And really high yield has been about the best performing sector. But it's still, you're looking at 3-4% year-to-date returns, really pretty modest. But I think what you're seeing, though, is the yield spreads still, to me, are telegraphing that the economy is okay, the fixed income market is okay. You've had spreads widen out, say 40, 50 basis points for most high yield bonds. However, most of that spread widening has been because treasury yields have dropped so much. From, say, their peak yield in April, where the 10-year was around a 460 to, say, a 380 now. That's an 80 basis point correction, and high yield has not caught up to that. So I think it's not showing any distress in high yield, that spreads have widened out a little bit. I think it's just this huge move in treasuries has changed that relationship, but the fundamentals are still there, still look pretty good for fixed income.
Yeah, when I looked at the spreads yesterday, I was like, oh my God, they're still so low. Like, I understand they went up, but so I guess my question, Margie, is what would a regime change or regime shift really look like then?
Well, frankly, I really can't see it. I think that we had a kind of a little play in value stocks. It sort of petered out. We've had a play in small cap stocks, which looks as if it's petered out. And so I think we're still back to the same themes as where do you want to invest in a slow growth economy, which is what I think we're really looking at over the next, certainly in the next few quarters, no matter what the Fed does. We're hoping, of course, that the Fed will see the light like the market and start to cut rates. But I think the economy is just going to chug along at modest 1% type growth. So where do you invest for that? You look at companies that are in the highest sectors, again, tech, certain parts of industrials, certain very few select in healthcare, maybe some materials. But in other words, it's still a very selective market. So we don't look for broadening out either, much as we'd all like to see it, but we just don't see that happening.
Margie, for better or worse, this is an election year, Margie. How does that factor into your calculus, if at all?
Well, historically, and there aren't many historic things you can rely on, it always seems that in an election year, no matter who gets elected, that we have a pretty good rally after the election into the end of the year. So I'm thinking we waffle around here because of earnings and uncertainty of the election. And no matter who is elected, we have certainty. And I would expect the market to have a strong finish in any case. And by that, I mean a modest finish. I'm not looking for say a doubling another 8 to 10% over the rest of the year, but 3-5%, something like that to finish off the year.
Margie, do you still, well, you mentioned slow growth, but we do have an election where it looks like both parties are going to be spending boatloads of money. The hyperscalers are spending boatloads of money. When do you think that really filters through and sort of helps stabilize that growth?
Well, it's true. You have a lot of capital investment going into certain sectors. Again, mainly the technology sector is the biggest spender, the biggest beneficiary. And so we think that trend is going to stay. And as far as fiscal spending, we already sort of blew the doors off for the last few years, either with COVID expenditures or inflation or infrastructure expenditures. So really, it's really difficult to see another big blast of fiscal expenditures helping to push up the market of the economy short term.
All right, Margie Patel, thank you so much. We appreciate that. As always, appreciate that perspective. Margie Patel, Senior Portfolio Manager, Allspring Global Investments, joining us from Boston, Mass. Via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Speaking of Uber, let's go to Mandeep Singh.
Let's do it.
He knows what's going on with these companies. Mandeep Singh, a technology analyst for Bloomberg Intelligence. He's all over these ride-sharing companies. Uber, Mandeep's going to be joining us in studio. We just picked him.
Yes, he runs
he's
into
literally
the
running
studio.
in our studio. So he covers all these ride-sharing things, and I don't know. He's the one that got pitched me on this whole Uber thing, and I'm on it. I think
he was right.
It's the greatest thing in the world. Uber, talk to us about the quarter, Mandeep. What did you see?
Good print, solid top-line growth. I think the fact that we are talking about a business that's generating $40 billion run rate in a year, clearly they have the scale. The question for me when it comes to Uber 5 years down the line, long-term play, how disrupted their business model is going to be from the rollout of autonomous vehicles and robotaxis. And I know, it's not the right time to talk about it, but when you look at Waymo and how successful they've been in the 3 cities that they have launched, the part of the call was about how Uber is integrating Waymo inside their app.
What is Waymo?
Waymo is Google's autonomous driving unit. They have about 300 cars in San Francisco, similarly in a couple of other cities, Arizona. And what they have shown is their technology is ready for prime time.
Wow.
They have to get regulatory approvals to do it at scale. But that changes the unit economics completely. Right now, we are talking about a business model where cost per mile is like $5 to $7. Waymo can, at scale, they can do it 3 or 4 times cheaper. So suddenly the take rate model gets disrupted. Now, again, it's not hit prime time, but that's what Tesla is striving for. And the risk for Uber and Lyft is they will get disintermediated.
Wait, so it's not the fact that Uber would just go get a bunch of robo-taxis and use them, and eventually that would pay off over time because they're not paying drivers. It's not that scenario.
It's not that scenario because both these companies want to roll out the robo-taxis themselves as opposed to using an Uber. And even if Uber was to get involved, their take rates would be way lower than 30%. Right now, they're getting 30% of every ride. Let's say it's a $50 ride. Uber makes at least 30%. That's a pretty healthy take rate. With the autonomous driving equation, first, Tesla wants to go solo. They don't want to partner with any of the ride-sharing guys. That's one risk. Waymo is on Uber, but my sense is they also want to kind of broaden out their reach, and they will deploy the technology themselves. And in fact, Alphabet allocated $5 billion in CapEx this quarter on Waymo's rollout. So,
all right. I mean, all right, it's bad enough that I get in a car with somebody I've never met, a total stranger. That's crazy enough to think about. Am I getting in a car that's a robo-taxi? Is that really going to be a thing, and if so, when?
I mean, these vehicles are monitored. So if
by the way, I have a Vespa scooter, by the way, so I don't necessarily need them for the shore, but go ahead.
But just go to San Francisco right now. You can order a Waymo ride.
You can.
You can. And just get that experience. I think every consumer who has taken a Waymo ride loves that experience.
Really?
Uber talked about, they acknowledged the threat on their call, but they also think the rollout will be slow, and they are positioning themselves by seeking all these partnerships. They're partnering with BYD for 100,000 vehicles. That was big news last week.
Well, then why would it be exclusionary? Like if Tesla rolls it out themselves, why is it that it just means more competition? It doesn't mean it's exclusionary. Like with Lyft, like you guys price compare with Lyft, there's room for more than just one.
There is, but then it goes back to being the scale player and having that 30% take rates. The reason why Uber has done much better than Lyft is because it's a scale player. And it can charge that 30% take rate because it has the liquidity in its marketplace, the supply-demand matching, the best ETAs, the most options that it can offer to its riders. So, like, marketplaces are all about scale. The moment you have more than 3 or 4 competitors, right now it's a duopoly, and still we see how badly Lyft is doing relative to Uber. If you have more competition, that's not good news. But again, this is further out. This quarter was solid. Nothing goes wrong for Uber until this robo-taxi rollout plays out. So we're talking a few quarters out scenario.
Market cap for Uber, $132 billion. Market cap for Lyft, $4 billion. What happened?
Well, I mean, Uber clearly has the scale, and DoorDash has done similarly very well on the food delivery side. So you've got 2 scale players when it comes to ride sharing and food delivery, and they have the most supply. I mean, one challenge with this business model is gross margins can never be as attractive as your software companies.
Yep.
And that's what we keep finding with Uber. It's like they're still a 40% gross margin business at an aggregate level. So where do you...
And for him, that's terrible. I mean, for most of the world, that's
like,
a great gross margin. But for Mandeep, if he doesn't see like 80% gross margin, he doesn't even pay attention to it. Mandeep Singh, thank you so much. Mandeep Singh, he leads our tech coverage along with that fella Anurag Rana. Lead our global team, technology research, one of the best on the street.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And one of our favorites is Jennifer Rie. She is Bloomberg Intelligence Senior Litigation Analyst. There's literally no one better, internally or externally at Bloomberg, who knows this antitrust world better than she does.
Yeah, like I wouldn't call up Paul Weiss or Skadden or any of those firms. I'd just go to this fourth floor of Bloomberg, talk to Jen Rie.
100%. And this headline crossed yesterday, right as I was going to go on TV at around 3, that a judge ruled Monday that Google illegally monopolized the search market through exclusive deals. So it basically pays to get their search function on your phone. I'm just going to dumb that down for a second. This could be huge, not only for Google, but it could also be huge in terms of like Apple. They could lose billions potentially in revenue from this. So we wanted to bring in Jen to break it down. Jen, can you just explain to me in more detail kind of what the accusation is here?
Sure, of course, and thanks for all of your comments. So Google basically was found to be a monopolist in general search services, and I think that's probably no surprise, right? We all use Google. I think they have 80 or 90% of the search queries in market share. But specifically, what was found to be illegal was Google paying many other third parties, including Apple, Mozilla, Samsung, other OEMs, to set Google search as the default search engine at all the access points that, where you need to access the internet. So for instance, behind a browser, behind Mozilla Firefox, or behind Apple Safari. And so what the judge said is, well, by placing Google as the default, this really blocks out all the other competitors, the search engine competitors. And at the end of the day, they can't get better if they can't get to customers, because search engines get better based on the number of searches done. And Google's got all those searches locked up. And that was anti-competitive because it was exclusionary and probably hindered innovation, might have hindered choice, and possibly hindered quality.
However, the stock is unchanged on the news here today, suggesting that the market doesn't really care. Should the market care here? Are there some remedies that might be really onerous on Google?
I think there could be. I think part of the reason the market's not really reacting is because this was just a liability phase. So the remedies have yet to be hashed out. And, that process could take 6 months. It could take even another year before we know what they are. And then Google will likely appeal and can seek to stay any remedy pending the appeal. And if that happens, you're looking at several years before there's any impact at all. But at the end of the day, the remedies could be onerous. First of all, the DOJ will seek structural change. I don't think they could win it here, but one of the requests they might have of the judge is to break apart parts of Google's business.
Wow.
Again, I think that's a long shot here. I don't think it'll happen. I think it's more likely that what the judge will say is, Google, you can't pay anymore to have that default position. And maybe the judge will say, Google, you have to share some of your data with some of these other search engines, or maybe some other new nascent search engine that comes into being after this remedy phase is finished.
Okay, so if that's the case, I wonder, does this change if President Trump wins the White House, or is this kind of like locked in?
It's such an interesting issue right now, Alix, because one might have said if an administration changes from Democratic to Republican, it could change, and there might be more of a likelihood of a settlement. But you have J.D. Vance as former President Trump's vice presidential pick, and he actually is aligned with the idea of breaking up Google. He's pretty anti-big tech. I don't know how much he would influence the policy decisions of a Trump, DOJ, or FTC, but if he did, he would be all in on continuing to go after Google. So I think the possibility of some kind of a settlement that's easier on Google happening down the road is low.
Jen, I think if you stopped any person on the street, they would say, I got no problem with Google. Actually, it's great. It's changed my life for the better. Is this one of those issues where it's a solution in search of a problem here? And does that factor into remedies?
Exactly. You're thinking like a lawyer now, because
that hurt.
There's a lot of commentary when this case was brought that the DOJ brought the case, but they really don't have a solution, and they brought it before they knew what the solution would be. We're going to get into what they're going to suggest the solution, but Paul, exactly why you said, people love Google. And this is exactly why I think the judge wouldn't do something structural, because he's not going to want to mess that up. People like Google. Google's essentially a free product, at least for people, not for advertisers. And it functions very well. And despite having a monopoly position, the judge did acknowledge that Google continues to innovate in the search area. So I think because of the desirability for consumers of the Google search engine, we're not going to see something structural. But I do think, obviously, the judge is going to have to impose some remedy because he found that the company is acting anti-competitively.
This is a weirdly unfair question to ask you. Is big tech too big? Like, do we have a big tech problem?
Well, I think that's what the current administration thinks, yes. But, there's a disalignment here with our Supreme Court, because our Supreme Court has ruled over and over that it's not illegal in the United States to have a monopoly. And in fact, that's what we want all companies to work toward, because that's what will cause them to innovate and try to gain market share by lowering their prices. So at the end of the day, just being big, at least today, isn't illegal. The problem is the conduct of a company that's really big. Right. And that's really what the DOJ and FTC are going after right now.
How about other tech companies? What does this mean for them?
I think it's atmospherics because there are different facts, different issues, different markets, and different market positions. The case against Amazon, against Meta, there are more case against Apple. They're quite different, and these cases rest on the facts and the specifics. But what this does do, at least for Google, we have one more case coming up, a big one against its ad tech stack that's going to trial this September. And now Google's been found to have monopolized two different parts of its business, its Play Store and now search. So psychologically, it could influence a judge to think, well, they've been found to engage anti-competitively in two areas, why not in a third as well?
Paul, this goes to your area too. I was reading a piece today that big tech's AI problem is just going to buy smaller companies and getting their talent, right?
Right.
And I wonder if that has to kind of go away now, because if you have this kind of DOJ.
Yeah, it's interesting. I mean, I think what I understand from people like Jen is that some of these big tech companies, their hands are really tied in terms of big deals, at least.
Yeah, Jen, do you think?
Oh, absolutely. Their hands have been tied for the last 3 years. Things could change a little bit with the new administration. I think there is no doubt, no matter who's elected, there will be some change in the leadership positions, the decision makers at the Department of Justice and Federal Trade Commission, and that could change things. But I do think big tech is still going to have a lot of trouble going forward trying to do any kind of a big deal.
All right, Jen, thanks a lot. We really appreciate it. Awesome. One of the best in the business, the best, if not. Jennifer Reed, Bloomberg Intelligence, a senior litigation analyst, joining us on Google being accused of monopolizing search and sort of the ramifications of that as well. It is interesting, though, that markets are super taking this in stride. Yesterday when the news broke, the stock was down like a couple percent and didn't really move at all from that.
I mean, tech investors have been used to this from the Microsoft days back in the 80s, 90s, and 2000s. And even they look to big tobacco and they say, and big tobacco is just powered right through all that litigation risk here. So you get to these companies that get to such a size and such a strength that it really doesn't matter. The horse is kind of out of the barn here. So we'll keep an eye on that.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.